Hi, welcome. My name is Phil Grande, and welcome to my videos. You know, nobody talked about this in the media, especially in CNBC. There was a big event that happened in June. We had the first week of June, probably the last week of June, I'm sorry, probably one of the biggest uh, stock sell offs in the history of the stock market. We had a big stock dump. Now, the reason why I'm bringing that up is because if you think about it, let's go take a look at history here. And history tells us what's going to happen in the future. In 2007, okay, when the market started to collapse over here, 2007, okay, and the market fell, giving back over, cutting in half. All of a sudden, the Fed stopped, the Federal Reserve, and they put in what they call a stop, backstop. I call it a steel I-beam pattern. Now, what it was simply they wanted the market to stop going down and to start reversing itself right here. So they decided to change the accounting rules because the reason the market was going down, and anytime the market goes down, is because the banks have to lead it down. The banks also lead it up. But they are leading it down because the banks' earnings were getting terrible because they were getting hit. Banks didn't trust one another, their balance sheets. So therefore, banks were selling their mortgages back and forth to each other. Okay, usually you take $100,000 mortgage and you sell it to another bank at $100,000. But what's happening is the other banks wouldn't buy each other's mortgages. Okay, so the $100,000 mortgage, just like it's the appraisal is what somebody's willing to pay for. It's the value. Was got a haircut of 5,000. So a price of a stock at $60 dropped down to to $5. Well, they had to stop that somehow. So they came up with an idea to backstop it. They changed the accounting rules, so no longer would they judge a stock's value by a market value, what one is willing to pay for it, but they changed the accounting rule just for the banking industry alone, where the bank could determine its own value on its mortgage portfolio. So the mortgage went back from 5 a value to 100. Therefore, the bank stocks drove up 400%. Right there, 400%. That's what got it started. Well, they knew that wasn't going to just keep it going mark to market to change it to mark to model. That's not going to work because the problem, what drives a stock market anyways? Well, you have to have earnings. In other words, people have to make money, right? People got to turn around and they got to have good wages. You have good wages, and with good wages, they go to the mall and they buy stuff, right? They buy stuff from the mall, and then the mall has to replace the stuff, and the companies replace it. Before you know it, the companies have good earnings. And what are earnings? Earnings the same thing as a profit. Okay, it has good earnings. Earnings then pushes up the stock price. So if you have good top line sales, okay, called revenues, and then from revenues you get earnings, and from earnings, if they're good, you get a higher stock price. Well, what starts all that is you got to have income. Well, people lost $12 trillion in net worth, household net worth. Nobody had any money. So how were they going to get, after the market went up 400%, how were they going to get here and get it moving up? Well, that's when they came in with two tricks. Okay, one was QE. Okay, QE. And what did QE do? Couple things. QE, they took $3 trillion, printed $3 trillion. Okay, we had the old printing press right over here. They brought it over here, the printing press. And he was down here, Ben, and he's going to print all this money. So he printed $3 trillion. He lied to everybody. He said, "Oh, I'm doing that so that I'm going to create jobs." He didn't create any jobs. $3 trillion went right smack into the stock market. Okay, and that pushed stocks up. The next thing that happened was they decided, okay, let's do stock buybacks. So now they started with stock buybacks. Now, why are stock buybacks good? Well, stock buybacks are good because, actually, they're not good. They're only good to move the stock up. Stock buybacks, what you essentially do is you take most of your profits and you take your most of your dividends, instead of putting it into machinery and the key thing, wages, increased wages, okay? Machinery, IT spending, new rolling stock inventory. Instead of putting it in those items, which means you're putting it into the economy, which means you're growing the economy, called the GDP, okay? And that's how the GDP grows, okay? So GDP, your economy grows from the profits of companies and their earnings if they put it back into their company and into jobs and into wages. That filters to the economy grows, and you'd have a GDP of about 5% is what we would have normally, 5%, which would give us about 400,000 jobs a month. Well, we don't have that right now. Okay, we have about 200,000, two and a quarter a month in jobs, and we have a GDP, a real GDP. They're telling us 2%. Real GDP is about 1.5%. It creates about two and a quarter jobs. All right. So here we are. So now we've got stock buybacks, and what they do is they buy their own shares back. When they buy their own shares back, that means there's fewer shares that are outstanding. So that means they take the earnings or profits and spread it over fewer shares, and that makes the earnings increase, and that makes the stock price go up without the company having to have sales or anything else. So it goes up on its own. But the problem with the stock buybacks, we started out with about we started out in March of 2010 with stock buybacks of about 50 billion a month. 50 billion a month. That's what we started out with. The problem with stock buybacks is it gives the company no value to the company, no added value. The only people who make money with stock buybacks are the CEOs and the shareholders, but the economy doesn't benefit and the company doesn't benefit. So 50 billion, they started that around 2010. In 2010, they started that trick. Okay, they're doing some earlier than that, but let's do 2010 because that's when they really started cranking up about 50 billion. So the stock buybacks went up. At the same time, they did another QE trick. They decided to buy all the 10-year treasuries. Okay, so what they did is they took the 10-year treasury right here, and they usually sell a lot of these 10-year treasuries. They always sell 10-year treasuries to the Saudis, to the Chinese. They're the big buyers of treasuries. And let's say at that time it was the yields were 3.1%. At 3.1%, China Saudis were more than willing to loan money, and what they would do is they would take and they'd loan money to the Treasury. Okay, they loan money to the Treasury. Chinese and Saudis, they put money to the Treasury, they loan it to them, and in return, they would get a Treasury. They get interest of 3.1%, loaning money to the Treasury. That's how it works. They get these certificates, and they would be for 10 years get that kind of return, which they liked. So to move the market up, because there's no wages or business, what Bernanke did, got the printing machine, and he printed all this money, and he went over here and he bought all the treasuries, so they couldn't buy them. So he bought the treasuries, and the more treasuries you buy, the yields drop to 1.1%, making it very, very unattractive for the Saudis and the Chinese. So the Saudis and the Chinese, who are the big buyers, we'll put Saudis here, and Chinese, they turned around and they said, the heck with this at 1.1%. It forced them over to the stock market, pushing the market up even more with no wage increases, no profits. Remember now, all this movement, here you got, that's 2010. Now you're up to 2012. So at 2012, we now have increased our stock buybacks. Okay, 2012, we increased our stock buybacks because remember, we stopped. QE ended. Remember, QE ended in 2012. So QE ends in 2012. So they ramped up from 50 billion now up to 100 billion buying their own shares, because remember, every time you buy your own shares, your earnings go up artificially and your stock price keeps going up without sales. So you just keep reducing the amount of shares you have available in the stock market. The company has available to trade. Keep reducing, and earnings go up and price go up. But the problem is your company is really getting bad by now because you're rolling stock. Your trucks are getting old. You're not replacing your equipment. You're not adding on to your building. Your IT is outdated. So now you can't produce like you used to. But who cares? The CEOs don't care. The shareholders don't care. They're making a fortune. So 2000. Now finally, now with all the stock buying, they turn around and they go right up to 2015, where we are right now. Now they've increased it. I'm sorry, 2014. 2014. Okay, they turn around and they increase the stock buybacks from 100 billion now up to about 175 billion a quarter. So think about this. Once QE stopped right here in 2012, we really wrapped up from 50 billion a quarter to 175 billion. Stock buybacks were incredible. So, but all of a sudden, what's happening is the stock market stopped dead. Okay, it's been this way for about 5 months. But June really told it all. June, we had all the big institutions bailing out, pouring out. They're getting out. Even Bank of America clients dropped 4.1 billion in shares, so they dumped 4.1 billion. Blackstone dumped in a deal 90 million shares. Okay, I mean, it's just incredible. We never saw historic this kind of dumping. So that's where we stand. So that's why the market's having trouble getting out. So you can't break out, and we're caught now in a trading range. We keep getting caught in this trading range, okay? And that trading range is not going to change until we do something. So we're in this trading range now. And the problem is, how do we break out of the trading range? Well, you only can break out of the trading range if people get better wages and people get full-time jobs. Well, nobody's going to do it. There's no way to do that now. It's been 6 years. So now, and he's ramping down. And remember, what killed us was Obamacare, because they had all part-time jobs. He never focused on full-time jobs. So what's going to happen is, the more money comes out, we're going to start having a collapse. Now, here's the problem. The treasuries now have gone back up to the treasuries now since then are back up again to 2.2%. Let's use that 2.2, 2.3. Let's average it out. So right now we got to buy oil this fall. So this fall we're running into a problem. We got to go buy oil. We don't have any money for oil. The government has no money for oil, so it's got to go back to China and the Saudis. Okay, and right now a lot of the Chinese and Saudis, we're going to buy oil, and we got to go to them for money. And right now we're at 2.3%. The government can't pay 2.3% for money. It's too expensive. They want to pay down here. So what's going to happen is we're going to switch players. Okay, we're going to start getting a 10% correction in the market as more people bail out of the market. I think you're going to get about a 10%. You get a 10% decrease in the stock market, okay, during the bailout here, because I don't think we're going to be able to go the other way. There's no catalyst to go that way unless they do QE early. So what's going to happen is that as they pull out, the market keeps coming down. The stock market's going to, start correcting, and let's say the stock market comes down now to about 10%. Okay, what they're going to do is the stock market comes down. Bernanke's going to print money. He's going to go in and buy all these treasuries like they did before to bring it back down to 1.1%. So that two things happen. They're borrowing money cheaply to pay for their oil. They got to start buying this fall. And it would also push the Saudis and Chinese back up here into the stock market to push it out, to get the stock market pushed out. So that's what I think is going to happen, okay? The only way we're going to get this market to push out is this fall when we start buying oil. They have to do QE again. But how far this QE go? I don't think the QE is going to work this time. And here's why. Because if you go back and you look, okay, at the last time, it gave up its bang for its buck. We started out with $1 trillion the first time, and the market shot up 80%. And then the last trillion, we only could get the market to move 25%. That's when we started all the stock buybacks, see? So if we only could get that kind of bang, and we've been having all these stock buybacks, the QE may not work as well this time. Then you could get a real deep correction. You could get a correction of, which I think you're going to get a correction in the market that's going to go, is going to come all the way back down where it started, down here at 7,000. I think we're going to come all the way back to here is my guess, because this has not been a recovery, it's been a bubble. I hope you enjoyed this. See you on the charts.